starting this chapter, we actually start talking about auditing as a diversity auditing profession, the legalistics and all. But I want, before we start, we're not going to even touch the screen yet. What I thought I'd start with today is actually talking about audits per se and clients and audits. There's nothing in the book. If you think about what an audit is, or even if you think you know what an audit is, let me ask you a question. You believe most clients in a perfect world would want to be audited? No. Would want an audit done? No. No. So in effect, we're going to learn how to do something that you've got to understand. We're going out into a world doing something that if clients had their choice, wouldn't do, okay? Let's come up with some reasons why clients have audits. And I can come up with half a dozen or so reasons why a client would have an audit. So why are we learning to do something that in a perfect world clients don't want, okay? When I say they don't want it, it's not universal. Sometimes clients want an audit. There are reasons that you would want one, okay? Sometimes. But let's go through it. Let's understand what we're doing and why we're doing it, and what the atmosphere we're doing it in. So anybody want to give me why would a client get an audit?
It's like it can be
Excuse me?
sorry, it can be a company subsidiary from other company and a main office, for example, in France, so they send people who is doing subsidiary on company audit.
So that's a reason, right? A parent company would want to see their subsidiary. So one, a parent company would want to see that their subsidiary was audited. They're in France, they want to make sure things in here, so a parent-subsidiary relations. That's a good answer. Give me another one. How are we doing this?
To show clients that you're honest, or to get that stamp of approval.
To show clients? What do you mean by
not
clients?
sorry, investors, my bad.
Okay, so investors would, not to show that they're honest,
To prove that.
they're the numbers. So investors, okay? Investors you want to go to your investors and show that your numbers are good, right? What else? What other reasons are audits done?
So you assure that it's going through policy procedures.
Excuse me?
You can assure themselves that it's correct through policy procedures and they're not.
Well, what you need to do in an audit, to do that, you want to check the procedures, right?
Yeah, so they can assure themselves that,
Show themselves
or be
assured
yeah.
that their numbers are good. Yeah, sometimes a company would want to see that their numbers are good. See that their numbers are good. Let's make sure by auditing that our numbers are good. Well, give me another one.
We're going to put this in like doctor terms, but have you ever wanted to go get a checkup?
Well, isn't
really
that sort of this?
Yeah. You really
isn't this sort of that? You're doing a checkup?
Yeah. But most people don't want to do it. But they do it to reassure themselves.
Sometimes they do, right? But that's what I'm saying. You want to make sure your numbers are good, okay?
Financing.
Financing. You want requirements. Let's talk about requirements. Requirements, okay? Financing. That's one. Banks, depending on what you're borrowing from them, aren't going to lend you money unless you have this done. So you need an audit, okay? Here's an easy one we missed. How about public companies? By law, okay? Public companies need an audit. It's legal, okay? Certain things that have governmental control over them, not for profits. There's one, pension plans. If you're running an employee benefit plan, and there's more than 100 eligible employees, employee benefit plans, required by law, along with your federal tax return, you have to supply an audited financial statement. About this, you ever want to do an audit? Do you think companies do audits sometimes? Check up on their employees, keep their employees honest? You want to make sure if my controller, my CFO, my bookkeeper knows my accountants are coming in and doing an audit, it's going to keep them more in line. So sometimes it's done just to keep your employees, let's say, in line. Hey, the accountants are coming in, I better behave myself. Here's another reason. Potential acquisition. I'm going to sell my company. This happens all the time. We go in on a client, we go in on a brand new client, say, well, what kind of accounting services? Well, I've only had a review. You know, I know my numbers are good. My controller does a good job. I don't want to spend money on an audit, okay? I want to do this. Why do it? It's just a waste of money. The financial statement's just going to go in the drawer. Why spend all this money doing an audit? Oh, you planning on selling your company in a couple of years? Yeah, that's my goal. You know, I've been building it for 20 years, and I want to cash out in a few years. Well, you don't sell a company today without audited financial statements. I mean, the likelihood is if you do, you're going to get less money for it. So potential acquisition. How about potentially going public? Potentially going public. If you remember, I said with public companies, when they file their financial statements with the SEC, you need 3 income statements and 2 balance sheets. Last 2 balance sheets, last 3 income statements audited. So you don't call up the SEC one day and say, I'm going public tomorrow, and I'm going to start my audits now. They say, okay, when you file your statements to go public, we want 3 audited income statements, 2 audited balance sheets. Well, you don't necessarily go back now and audit for the last 3 years. That's hard to do. Auditing 2 or 3 years ago's information. So you gear up for it normally by getting audits done. So there's a whole slew of reasons why these are done. And you're right about one thing. For the most part, companies don't want to do them if they don't have to, okay? They do them normally because they're required to. Somebody, like you say, investors and banks require them. Public companies are required. Employee benefit plans. Some not-for-profits have to be audited. So there's a whole bunch of reasons why we're doing what we're doing. Let's assume that all companies are audited. Now, outside the United States, in some countries, audits are required. They're required along with tax returns. I don't remember, I think some of the European countries require audits. All companies get audited by law. That's not true here. The only companies that are by law, like I said, the employee benefit plans, all the public companies, certain of the not-for-profits are audited. So that's why we're doing this. Now again, we're doing it in an environment that to some degree, I'm not saying clients are resistant to, but it's not one of their favorite things. Okay, let's understand that. So anyway, we're going to start talking about audit evidence and documentation and what we're trying to prove by an audit. What is the purpose of doing it? And what do we have to do to accomplish a successful audit? Auditing has changed over the years in terms of what we are looking at. But in the year 2015, the word is risk, okay? We're always dealing with risk. That's what we're assessing, risk. And we start with today, we talk about audit risk. And what is audit risk? Well, it's simple. Audit risk is that we're going to miss it, okay? So we're going to issue an unqualified opinion on statements that contain material departure from GAAP. So that's what we're trying to avoid. Trying to accomplish an audit that minimizes, we can never eliminate it, but we want to minimize the opportunity that there's a material misstatement. So that's what we're trying to accomplish through our audit and through our audit procedures and through our assessment of what the risks are. How do we eliminate them? We never eliminate them totally, but we reduce them down to an acceptable level where we're satisfied or it looks like it's okay by doing enough auditing and getting enough sufficient appropriate evidence. We've looked at enough stuff that we think is sufficient that we've reduced our audit risk to the point where we feel that the financial statements have the lowest risk of having a material departure from GAAP. Again, never saying they're exact, never saying they're perfect, just saying they're not materially away, that there's not a material departure from GAAP in them. That's what our goal is. That's what an audit's all about. Now what we're going to talk about a lot is what are called assertions. Okay? We're going to be auditing assertions. We're going to be looking at different assertions about different accounts. And when we talk about accounts this semester, in each of these classes, we're going to be looking at different accounts and what the assertions are. So we're going to be looking at what the assertions are about accounts, about classes of transactions, and about presentation and disclosures in the financial statements. All are important things because remember, the numbers may be okay, but if the presentation and disclosures are not adequate, you still have a departure from GAAP. If your footnotes are deficient and aren't giving the proper disclosures or either incorrect or saying or leaving things out that are required by GAAP, you have a material mistake. So it goes beyond just getting the numbers right. It goes right down to the disclosures in the financial statements. So there's a sketch. What are some of the assertions? We're going to talk about this. We're going to talk about the assertion of existence, rights and obligations, completeness, valuation, accuracy, cutoff, classifications. They put them into these different columns of accounts, transactions, disclosure. I'm not going to beat this thing to death. But these are the assertions that we're going to start talking about when we start looking at accounts. What is it we're trying to prove? What are these assertions we're trying to prove about something? And if we look at, I guess we let you loose, huh? What? Good. So let's look at some of these are very, very important assertions. We're going to talk about them all semester. The things you're going to do in accounting, the things you're going to be doing in auditing, okay? The first assertion talks about existence, okay? That assets, liabilities, and equity interests exist, and that the recorded transactions have actually occurred. That's what we're auditing for. Do these assets and liabilities, are they real, okay? Or are there things on the books that aren't real? Did that happen? Absolutely. If inventory is overstated, okay, might be because there's items that really don't exist on your books, okay? So we certainly have to prove our first assertion on a lot of things. So we have to prove that they exist or that transactions actually occur. That's what auditing's about. We're going to prove that both of these things, that these things exist and the things are recorded actually did occur, that they're not just fakes. Does that happen? Absolutely. Did a transaction occur? Right. Company wants to inflate their income. They make up fake invoices. Okay? They make up fake invoices. Debit receivable credit sales. Here's a tough one, okay? That's the first assertion. There's transactions that didn't occur. So we're going to try to audit to minimize the risk that the existence and occurrence assertion is a problem. Rights and obligations. The company has rights to the assets and liabilities or the obligations of the company. Okay, we prove there's receivables. Does the company have the rights to these receivables? Is that bank account really theirs? That building that they pointed to across the street that they say is on their books? Yeah, there's a building. I proved there's a building. I saw it. It existed. It's right there. But is it their building? Okay. Is it theirs? The liabilities, are those their liabilities? Or are they trying to reduce their tax obligation and putting liabilities on the books? Debit expense, credit liabilities for things that aren't theirs. Okay? So we have to, the second assertion that auditing goes after is that we have the rights, the assets, and the liabilities that really exist belong to the company. So we prove, in the first one they exist, the second one, are they the company's? Completeness. This is certainly one. Is everything recorded? Or do I have to go into the controller's desk and rifle through and find invoices he didn't want to accrue? He didn't want to book some liabilities. He didn't want to book some assets. He wanted to reduce income. I'll hide some inventory on the auditors, okay? So everything we saw inventory, it existed. We proved that. There was a pile of inventory. It existed. We did the second thing. We proved that the inventory we saw belonged to the company. The only problem was the third thing, we didn't know we had everything. We're missing some stuff. So the third assertion we've got to do is to prove that everything is there, that we have the whole story. Cutoffs. Here's what we do on all these things. We figured out the existence, the right, the completeness. Are transactions recorded in the right period? Are transactions in the right period? So we saw the sales, yeah, there's sales that exist. They belong to the company, so the sale passes the existence test, or the occurrence test. It passes the rights and obligations test. It belongs to the company. Completeness, yeah, there's the invoice. We recorded it. The only problem is it's next year's invoice. It doesn't belong in 2014. It belongs in 2015. So we didn't pass the fourth assertion that things are recorded in the proper period. Valuation allocation accuracy. That all transaction assets, liabilities, and equities are included in the financial statements at proper amounts. Yep, we have that building across the street. It exists. It's ours. It passed number 2, rights and obligations. Completeness, yep, we got the building. That's our building. I didn't leave off half the building. Cut off, I bought the building in 2014. It should be on the books. Here's the only problem. It went down in value tremendously. So I have a valuation issue. So it passed all the other tests. The only problem is it's on the books for the wrong amount now. I didn't write it down the way I should. I've got the wrong reserve for bad debts. All my receivables are good. My rights and obligations to them are good. They're complete. I've got all my receivables. They're in the right period. I did a bad valuation. I've got the wrong reserve for bad debts. So when we start auditing and we start going through the accounts, we're going to start looking at these assertions as they relate to particular accounts. They're more applicable to some than others. Take valuation, for example. When I audit a bank account, cash account, I don't have a valuation issue. As long as it's valued in dollars, it's got $1 million in the bank, I have $1 million. I don't have to look at $1 million bank account and whether or not the valuation is correct. So some of these are more applicable to some accounts than others. But this slide, which talks about assertions, is extremely important that you understand this. Because within the context of what's here is what we now sit back and we use to audit accounts. And this comes under common sense, in all honesty. I wasn't taught all this stuff. And I'm not saying that was good or bad. What I'm saying is when we went out to audit things, we used common sense as to what we were trying to prove. But when you look at those 5 items, you would say, you know what? Yeah, if I took a particular account, those would be the type of things. If I, at the end of the day, want to see if an account is correct, and the number that I'm presenting on the financial, that's being presented in the financial statements, to which I'm opining on, is correct, you would have to pass those 5 tests. Because if it fails one of them, you've probably got a material misstatement in your financial statement. So that's what we're using as a backdrop to then go in and come up with what our auditing tests are going to be. And lastly, of course, is presentation and disclosure. We get all the numbers right, pass all the tests, but the financial statements, we don't put them in the right place. We classify things wrong. We put things in current assets that should be long-term assets. Worse yet, we put things in long-term liabilities that are current liabilities. And we don't give complete, appropriate, and clear disclosures in the back of the financial statements. So this is after we've done the numbers, then we put the numbers in the financial statements correct. In other words, they don't have the proper controls in place to detect those. So these are company-related inherent risk and control risks. If you don't have the proper controls to stop finding, to prevent or detect one of these, And the inherent risk is whatever the word inherent that's in a particular account. And as we talk about accounts, some accounts are going to be have more inherent risk than others. Some clients have more inherent risk than others. Okay? We can give examples, and I can give examples of things and say, well, how much risk is there really in that? And you would say, as an auditor, not much. Other things you go to audit and you go, wait, this thing is really tricky, or this thing has a really high risk of being incorrect or having a problem with it. One of them, again, you guys have all taken Intermediate 2 and learned something about deferred taxes. Well, let me tell you, is there an inherent risk in the deferred tax provision being incorrect? Sure. It's a very difficult area, okay? And detection risk, which is now on the auditor, is that your procedures will not find a material mistake, okay? So this one's on us, the detection risk. So we're trying to minimize that after assessing these. So we assess these two things, inherent risk and control risk, and then determining what our audit procedures are. And that's what all the planning is all about. That's what you sit down in the beginning and are assessing. That's why I say auditing is all about risk. And we've really come around to this. This is not a concept that has always been in existence in accounting. Risk-based auditing is something we've evolved to. I wasn't brought up in a risk-based auditing environment. I think our environment was really one a little bit more freelance. Go out and audit the heck out of the numbers and come back and feel comfortable. I don't think we really assessed, well, this is where the risks are, this is where we got to spend our time. And maybe we did, but we did it sort of subconsciously. But really, auditing has come around to this risk-based concept. This is the formula that audit risk is these three things multiplied. Inherent risk, I'm not sure I understand exactly how they come up with these numbers. They came up with numbers in the book, and I'm a little confused at it, okay? So let's talk about inherent risk first, okay? What affects inherent risk? So if you're sitting back, you're looking at the environment, you're looking at the client, okay? First, the nature of the client and its environment. What kind of a company are you auditing? That's why the first thing you have to do when you audit is learn learn the company. Some companies are easy to audit, okay? I go in and audit a Burger King. Let's just pick that as an example, okay? Am I worried about the inventory? No, it's probably a small number. Fixed assets are probably, they bought them at one point in time, okay? What would I probably be looking for? I want to make sure that the control, we know that the systems are probably in place where, everything's going through the register, okay? I'd probably do it, and we're going to talk about analytical procedures to make sure that gross margins are in line, expenses are in line. But I probably don't think at the end of the day my risk of auditing a Burger King is tremendously high. I go in and audit some company that's dealing in fancy derivative instruments, or a company that's got global operations with inventories with funny valuations. Do I have an inherent risk? Absolutely. I talked to you, I think I mentioned to you that company that we were involved with for a short period of time. It was a string of jewelry chain. 300 stores in the Caribbean, or 100 stores, a lot of stores in the Caribbean. Was there an inherent risk in this? Tremendous. Why? Because the inventory is so difficult to audit. So we're looking at the client and its environment. We're looking at let's look at some of the problems. We'll talk about it on the bottom. So, and the nature of the financial statement element. Is cash hard to audit? Not particularly in most cases. It's a pretty easy account. Is receivables easy to audit? Some companies, they're simple. Some companies, they're extremely difficult. Some companies are paid very quick. I'll give you an example. I audited a company that was in the meat business. They were a meat studio. They sold to supermarkets. I don't know if the rules are the same today as they were then when I did it, but they have a very, very quick term. They have a very quick payment term in this industry. Everything had to be paid within 1 month. 1 month was long on receivables. Okay? Normal terms were 7 days, 14 days. How hard was it to audit receivables? December 31st. By January 31st, we were paid. By I came in February, I could see with receivables, they were all paid, I knew I didn't need an inventory reserve, or I mean, a accounts receivable reserve. Simple account to audit. I also audited a nursing home, publicly held company that owned nursing homes all over the place. Medicare, Medicaid, insurance companies, receivables that lasted years, payments for claims that lasted 2 or 3 years ago, reserved for bad debts, choke a horse, as they say. Hard to audit receivables there, yeah. So the inherent risk there was tremendous. The inherent risk in receivables on the meat company were virtually nil. So that you look at the financial statement element, the client and the environment, and you assess, is this a tough area? Do I anticipate it being pretty easy to audit, or are there going to be problems? What are some of the business characteristics indicative of a high risk? Inconsistent probability of profitability. Companies that go up and down. You look for patterns, you look for traits and consistencies in companies. Sometimes they're trends. A company that loses $1 million, makes a lot, loses. Well, there's one you're going to be a little bit more worried about, the one that the numbers look more logical to you, okay? Operating results highly sensitive to economic factors. I'll give you an example again of a client. Give me a client that was like that. I had a company that was into something called group incentive travel. They ran large travel groups. Companies take, like 500 of their top salesmen on a trip for being their top salesman. So they had clients that did this. They didn't have a lot of sales during the year, but the sales they had were rather large. Well, when we've had a couple of events in the world that cause people to get nervous, 9/11, Iraq, things like that, all of a sudden, people cancel these things, okay? And boom, they get 2 or 3 or 4 canceled trips because of fear of traveling with large groups of people around the world. Boom, economic factors, operating results. Perfect example. Is a supermarket going to have a line of that? No, people are going to eat every day. But is something like that business went from here to here in about 15 minutes.
Well, wouldn't a supermarket see that too?
What?
Like when there's recalls on the vegetables.
Yeah, but it's minor. I mean, okay, so they recall peas tomorrow, okay? I mean, peas is a small item in the whole supermarket, okay?
But that would be an example of that.
It would, but to do a very minor extent, not to the degree that this guy's business dropped like 50% in 20 minutes. Something was announced in the paper, and they got 3 phone calls, that said, "Oh, we're canceling. We're not taking 500 people to to wherever we're going because something just happened. They were going to Japan and the tsunami hit, okay? And the trip got canceled."
So it's mainly on materiality.
Well, I mean, sure, materiality. Going concern problems. You think a company's got a going concern problem? Yeah. Do you have a high degree of risk? Of course you do. You've had problems in the past. There's your first thing. When the auditors sit down, what do they talk about in the planning? How's it gone in the past? Do we have journal entries? Yeah, we went in last year, we found 30 adjustments. Well, there's a sign you better be careful, okay? Other clients you haven't made a journal entry on or proposed an adjustment since you know them, okay? Every year they give you clean financials. You're going to feel more at ease. You're going to probably feel you have less inherent risk. And then you look at things like this, substantial turnover. Hey, if they had 4 controllers this year, there's a good idea. There's a problem. Questionable reputation, inadequate accounting skills and management. We always assess how good are the people we're dealing with at the company. You go to some places and they're high quality, competent, they have enough people, they're good. You go to other places, not so good. All part of inherent risk. All the things you talk about when you're planning an audit. What are we going to do? How much work are we going to do? What is our risk of this going wrong? How about assertions with high inherent risk? Difficult to audit transactions or balances. Perfect example. Difficult to audit balance. We have a client in the scrap metal business. They buy and sell scrap metal. Want to try and value a scrap metal inventory? A little difficult, isn't it? You got to get weights, and you got to find out what costs were. You got to try and find out what's in there, but it's piles and piles of metal. You don't know what's in there. So is that a difficult balance audit, yeah, that becomes a little bit more difficult than auditing a bank account, okay? Complex calculations. Like you said, I have this company that has this thing called post-retirement benefits, where they guarantee their employees if they work there a certain amount of time and they retire there, after they retire, they will cover their medical for the remainder of their life. You want to calculate that liability, you have no idea how difficult. I've had it explained to me, and all the assumptions that go into it, the calculation of the estimated what medical costs are going to be and what life expectancies of their employees are going to be, and how many of the people who are 40 are going to be around long enough to be eligible for this, will go into this. Interest rate assumptions, it's very difficult calculation.
Then Ford just gave with $2 billion for that.
Excuse me?
Ford got hit with $2 billion for that.
Because of what, a post-retirement?
Yeah, because the census came out and the average living age went higher.
That'll do it to you.
So $2 billion they have to reassess the retirement plan because women
Exactly.
are high, men are high.
Didn't they also,
A good point. As we live longer, that liability would go up, and you've got to calculate into that assumption. And as you say, they got hit with a $2 billion adjustment as a result of that assessment. Difficult accounting issues, you haven't run into them yet, but there's a lot of them out there. Significant judgment by management, where they've got to do valuations, where they've got to do estimates on reserves. Yeah, those are high inherent risk. And valuations that vary significantly based on economic factors. Whether or not you're writing down real estate. Well, I've had clients, again, who have real estate in bad areas. All of a sudden, they're not using the property. What's it worth? Economic factors all enter into that. So all these things enter into what's called inherent risk. Transactions break down to three types when we're assessing. Routine transactions, which have low inherent risk. Those are things like sales. They happen every day. Non-routine, they put into there things like taking inventory, which you only do once in a while. That's a little bit more inherent risk. Because again, if I take inventory once a year, what's the chance they're going to take it correctly as opposed to count it every day? And of course, estimation transactions. Anything high, the highest inherent risk. Anything you've got to estimate. A potential liability, something that's not concrete, that you've got to use your best judgment. Reserve for bad debts is a perfect one. You're estimating today what an event in the future. This is one of those things you can't really answer if you say, what's enough, okay? What's the appropriateness of audit evidence? Well, we must obtain sufficient appropriate audit evidence. We have to have enough. How do you know when you have enough? When you give too much? It's a judgment call. You're going to do it you're going to make certain assessments on materiality, and you're going to use your auditor's judgment that you learn over a period of time to determine whether or not you have sufficient appropriate audit evidence. What is audit evidence? What makes it appropriate? It's got to be relevant and reliable. Relevant and reliable. So reliable, first thing off we probably ignore is these things that management tells us. Management says that, yeah, management told us that the bank account's good. I don't think that's a reliable evidence, okay? So what are the principles of getting good audit evidence? What are the things behind what we consider as accountants to be reliable, relevant audit information? Let's read these. Not obtained from knowledgeable, independent sources outside the company rather than non-independent sources. So our first thing is we are trying to get information from outside, okay? We're trying to get documents and verification of things from people not inside the company. You don't do an audit by sitting down with management and going over all the numbers. That's not an audit. An audit is trying to get the best information is what you get from independent people. People have nothing to do with your audit. People have nothing to do with your company other than maybe to verify numbers. A bank confirmation, okay? The bank says, yes, that's how much money we have. A customer that owes us money sends us a confirmation. They're independent, okay? Information is generated through a system of effective controls rather than ineffective controls. So if you're getting information internally, you're hoping it comes from a good, effective internal controls. Very important. Number 3, obtained directly by the auditor, then run indirectly or by inference. You have to go and get the information yourself. Anything wrong with this procedure? You know, I gotta send out accounts receivable confirmations to my client. Would you do me a favor? Here they are. I gotta go back to the office. Would you fill them out and mail them for me? Okay? Is there anything wrong with that procedure? Go through and go, this is the bad one. I'm not mailing that one.
That's a good
No, I'm going to change the number on this one. So can we have our clients mail our confirmations? No. We have to mail them. Okay? I'm going to tell you what, I'm going to be at the client's office next week. Instead of the confirmations being mailed to me in the office at Cohen, it's just as easy. I'll put the return envelope at my client's office. So I'll mail the confirmations, and they can be returned to you, okay? You'll give them to me when they come in, right? Thank you. They come in, you go through them, you go, that's the one I don't want them to have, and it goes in the garbage. So obtained directly by the auditor, then indirectly or by inference. We got to do it, we got to get it. We've got to gather the data. We can't let the client do it for us. Documentary informed rather than oral. We call the lawyer and say, listen, it's near the end of our audit. We sent you a legal confirmation. You didn't send it back. Oh, there's no problem. We don't have any cases outstanding. Thank you. Spoke to the lawyer. Not good. Doesn't hold up. Thank you very much, but I need that back in writing for my file. I need documentation. And lastly, provided by original documents rather than copies. I'm not saying you can't ever use a copy, but copies can be doctored in some cases. I told you that example of my client who was in the payphone business. Those were doctored copies of documents. They weren't real. So we want original documents, and you know the difference between original copies when you see them. So when you go to the client and you want to examine a contract, yeah, I'll give you a copy of it. Well, you know you got the whole thing, okay? So no, when possible, let me see the lease. No, I don't want to see the copy of the lease. Let me see your lease. So this audit evidence is the best stuff. The stuff that you get independently, you get from outsiders, you get originals, and you get in writing. This is all stuff that gets attacked when you have an audit problem. This is what they go after. What do you mean? Your receivables, your receivable balance, did you have the confirmations, Mr. Cohen? Well, no, I gave them to the client. Did you get them all back? No, I know some of them never came back. Did you know she mailed them? Did you ever find out that the one she didn't mail was the one that's the bad one, and you never got it back? Well, were they sent back to your office? No, they were sent to her. Yeah, that'll work. So we need to be able to audit under these principles. So again, we're going to go over an overall category. First is risk assessment. We do this on every audit. We sit down and we get a risk assessment. We take an understanding of the client's environment, including its controls, and assess the risk of material misstatements. We sit down as a team, the partners, the audit staff, and go, okay, where's our risk here? Where are things going to go wrong? Where do we have the worst chance of something going wrong? Because you don't want to spend half your auditing prepaid rent when the inventory account is the key to the audit. You know, this is where the issue is going to be in the evaluation of the inventory. It comes from knowing your client, knowing the industry, and knowing the way they keep records and knowing them. After you've done your risk assessment, you're going to do what's called test of controls. You're going to look to see how good their internal control systems are. So So we're going to go look and say, okay, here's where the risks are. Let's go in and see what kind of controls they have over stuff. They have good internal controls, bad internal controls. Once you've assessed risk, you've tested controls, you are now going to do what's called, you're going to design your procedures. And you're either going to have, which come under what's called substantive procedures, okay? And they're going to include what's called analytical procedures and tests of balances, transactions, and disclosure. So we're going to break our audit down into two. Once we've assessed the risk, okay, here's what could go right, here's what could go wrong, here's where we have to spend our time. We've tested controls, we've either said they're good or bad, or wherever they are, and determined what we're going to now audit and how we're going to audit. Then we're going to break our audit down into two things, analytical procedures and tests of account balances, transactions, and disclosure. So we're going to go in and audit the accounts, but we're going to do what's called analytical procedures, and we're going to talk about that in a second. Where we're actually looking at the numbers, not the details of them, but looking at the numbers overall to see whether or not they seem to be what we expect them to be. So what are audit procedures when you're going out and doing actual audits? What are you doing? What are the things you physically do? You're going to inspect records and documents. I mean, that's what you're doing. You're looking at the records, you're looking at the documents behind the records. You're going to sit down with knowledgeable people in the company and ask questions. This is why you have to become knowledgeable of business and knowledgeable about auditing. You're going to sit down and you're going to ask some questions. And you're going to ask what kind of questions? You're going to ask logical questions. Talk about the inventory. Where is it? What is it? What's going on in the business? Things that will help you in understanding the client and helping you with what your expectations are for what the results are going to be. Was it a good year or a bad year? Sales up, sales down? Are costs up or down? What's going on with your employees? What's going on with your union? So many questions you can ask that's going to lead you to an expectation of what you're going to find. External confirmation. We're going to talk about this in many, many ways. Where we're confirming. External confirmation. Where we can send confirmation letters to outsiders who are going to help confirm our numbers. Examples. Cash. We're going to send letters to the bank confirming our bank balances. We're going to send letters to our client, to our customers, confirming our receivable balances. We're going to send confirmation letters to outside warehouses. Lots of clients have their inventory in public warehouses. We're going to send confirmations to how much of our stuff do you have. We're going to send to liabilities. We're going to send to some of our accounts payable vendors, to the banks that we owe to, mortgages, all the people we owe money to, confirming the balances. This is what we owe you. And then finally, we're going to confirm the amount of stock outstanding. We want to confirm. The company says they have X amount of shares outstanding. Is that right? So we're going to send as many confirmations because this is great documentation. When the bank tells you, yes, that you owe, that what the amount that you put on the confirmation that you said is on the books agrees with their books, well, that's pretty good on our audit documentation that that's the amount of money you owe. We're going to inspect tangible assets, starting with something we always do, as long as it's material. We're going to count the inventory. The most obvious tangible asset. If inventory is a material number, you're going to count it. I'm not saying you count everything. You're going to test it. You're going to examine their counts. You're going to go do your own test counts. And you're going to do more than just count it, depending on what kind of inventory it is. When we say, like I said, when we inspect it, what does that mean that you would do? Okay. So, I'll pick on you. What?
So what's up?
Let me ask a question. Send you on an audit to a warehouse. Okay? Big warehouse, small warehouse. forklifts take things to the ceiling. Okay? Sells appliances. That's their business. They're appliance distributors. Walk into the warehouse, they tell you, I want you to test this inventory. What are the things you're going to look for? You walk in, and all you see are shelves and boxes. What are some of the things you think you might have to do to feel comfortable when you walk out of there? That what they say is in yours and if you have everything.
Could randomly check certain things. So you look at their documentation, what they have, pick a few things and go look for it, make sure it's there.
Okay. So they tell you, let me stay with him. So they say, okay, we have 500 Sony TVs. Okay? You walk over, say, okay, you're going to say, okay, I'm looking at your inventory sheet. You said you have 500 Sony TVs, what is it, right?
No, that's not what it is.
Okay,
what I meant was, so every TV is going to have a number identifying it, right?
They're in one boxes, yeah. Okay.
So I would go by that, but you don't have time to check all 500.
Would you count the, they said to you, what do I say? You don't mind, do you?
I don't know.
Okay. Because again, I'm not expecting to be an auditor, but you're now a new accountant with an accounting firm, and believe me, one of the first things you're going to do is count inventory. Okay? Somebody will give you instructions, but you got to use your common sense, and you want to feel comfortable at the end, correct? So I sent you into this warehouse. Clients, what they're going to do, they're going to give you an inventory list, okay? I say, you go test it. So you're going to probably pick some items you want to go see, right? Is that what you said? Okay. So you say, okay, I'm going to start with, I see you have 500 Sony televisions. You're going to ask them where they are, wouldn't you, probably? They might even tell you on the inventory sheet. So you walk over there, and there it is. There's a wall. They're stacked deep, and they're stacked high to the ceiling. Okay? What would be your inclination? What would you do? Feel comfortable. You get this wrong.
Well, I want to say that you look at it and you count the thing in math. Remember?
The bar code?
No, if you go at the bottom and then multiply.
Okay, so you're going to count the boxes.
Yeah.
And you're going to try and figure out the depth.
Mm-hmm.
Okay, there's a start. So you count them, there's 500 boxes. You happy?
No.
Do you know what you're saying?
Randomly check a couple of the boxes. If they have so many TVs in them and you count 500 boxes, and there you go.
You're going to now open the boxes. She's right. You got to open the boxes. Dina, you're going to be daring enough to say, I want to see one on the top?
Yeah, you randomly select one from the top, one from the back, one from the front, and there you go.
No matter whether the client gets pissed at you, got to pull one out from the back.
No, you'll pull it out.
Exactly. You're going to pull one out from the back. You're going to pick enough that you're happy that A, you counted the boxes, B, you found that what was in there was a TV set, okay? And you got enough of a sample around, because again, let's go to the crook, which we just figured out the crook. If you didn't have 500, you wanted to make me think you had 500. The empty boxes would be where I couldn't get to them, right? Or in the back. Or there'd be something else in the box. Does that happen? Absolutely. Crazy Eddie. Crazy Eddie. Does anybody know what he's talking about?
Yeah.
Nobody remembers Crazy Eddie.
Oh, I do.
You remember Crazy Eddie?
Well,
He went to
Professor
jail.
Levine.
Eddie Antar.
Professor Levine told us about it in intermediate one.
Eddie Antar, a local guy here in Jersey, down in, I forget what he used to come screaming on TV. He was in the electronics business. He was a retailer in electronics. And he always advertises the best deals, and he was screaming. Yeah, he was all fraud. He went to jail, Eddie Antar. Yeah. So you're right, Dean. If that's what you would do, you got to test things. So you use your best judgment. So when we took over this jewelry chain in the Caribbean, it's a little testy. Yes, I can look at it. I give you a ring, and I say, here is a 2-carat D quality, blah, 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 diamond ring that costs $50,000. I don't know that I'm looking at a diamond. And I don't know it's D quality. So sometimes you even have to bring in professionals. You have to hire outside people sometimes to help you with these things, because we're not qualified. So inspection of tangible assets. Are you going to go check and see if a building's there? You probably might check and see if a couple buildings. Yeah, there's a building there that's on the books. Are you going to go out and count all the computers in their offices? No. Are you going to look at it for reasonableness? Yeah, you have 100 employees and you say you have 1,200 computers on the books. Well, that doesn't make sense, okay? You're using common sense. You're going to go over processes and procedures performed by others. You're going to look how people are doing things. You're going to always recalculate certain mathematical accuracy. Thank God now for certain computer programs that we use. I think it's called IDEA. How do I know the general ledger adds? How do I know the accounts add? Well, there's software now that you can put onto their computer to check the mathematical accuracy of accounts. So you don't have to take a general ledger that's this big and re-add it, okay? Analytical procedures. We're going to talk about what those are, okay? So there's a whole bunch of things. You're going to check the recalculation of depreciation. Client gives you the depreciation schedule. You're going to check the math. You're going to check that the receivable schedule actually is. It's very easy, to say my receivables, yeah, this is the number 2, and this is 2, and this is 2, and make the computer say that it's 12 at the end. Okay? There's an easy one to do. How hard is that to do? So if I don't check the mathematical accuracy of things, I'm not saying everything, you're going to test it, and there's a lot of software out there that'll do it for you today. This is too small. So again, we're going to do analytical procedures, test the details. We're going to test account balances. We're going to test classes of transactions. We're going to test disclosure. Everything we're testing. We don't do anything totally. Does timing of some of your procedures make a difference? Does it make a difference when I test the inventory? Absolutely. Because we're so seasonal, it is so difficult sometimes to get all of our work done in February and March and get things done in time for the clients who want their financial statements all at the same time. As a result, we do what's called interim procedures. Some of your auditing you can do during the year. You can go and you don't have to count the inventory on December 31st. If it's a December 31st company, you can go in and do it at the end of November and test it and see if it agrees to the books at that point in time. But when you do, you have to do certain other procedures that roll it forward in effect to make sure that it's still accurate at the end of December. So the nature and timing of the procedures actually has an effect on whether and how much time you spend on the audit. It would be nice if we did every inventory on December 31st. It would be simple. But you can't do them that way. And sometimes clients don't want to do it that way. So we do some stuff during the year, but it may cause additional work at other times. When do you extend procedures? The greater the chance of a material misstatement, the greater the need of extended procedures. You also extend procedures, of course, whenever you run into problems on your audit. You do a sampling, and your sample comes out with mistakes. You've got to extend your procedures. And that's what a sample is all about. I've never thought I'd really understand sampling, and I don't think I ever will. When you have 20,000 items, and if you look at 60 and you're okay, you're covered. But sampling tells you that that's true. But God forbid, in that 60 that's due with a problem, then you've got to go look at 300 more before you can capture it, whatever the number is. So obviously, the larger the sample size reduces what's called the detection risk. The more I look at, the less chance I have of risk, and it brings down risk to a lower level. So sometimes, if I'm really scared about something, what am I going to do? I'm just going to look at more stuff. Anybody know what analytical procedures are? at numbers with expectations, okay? You're looking at a number and saying, what do I expect it to be? And judging how much auditing I'm doing by whether or not the number varies from what I expect it to be. And again, this comes from being knowledgeable of the client, knowledgeable of accounting in general, okay? And you base some of your risk assessment on your analytical procedures. Simple example. Company historically has shown a 5% gross profit. I go in and I do my initial risk. The client gives me their general ledger. They give me their numbers. I look at them and the gross profit is again 5%. My risk assessment says the probability that something's wrong with gross profit is going to be low. That's what I'm anticipating. Now we do analytical procedures twice. They are required twice in an audit. There are what's called initial analytical procedures, from which you judge from which you base some of your substantive auditing, and then you do what's called final analyticals to see if the numbers came out the way you want them. So I get the client's initial trial balance. I look down it, and I say, whoa, inventory's double what it was last year. You think that increased the inherent risk? Yeah. What was that? Wait, I'm not sure why inventory went up. And they ask me questions, and then they alleviate, oh yeah, we have another warehouse this year, we've grown a lot, we need to be more ready for our customers, so we've increased the amount of our inventory. Okay? We haven't been able to supply our customers as quickly as they want, so we increase our inventory. You might get answers that satisfy you, but your inherent risk is going to go up when you see a number jump out. Receivables are higher or lower than they were in the past. Or certain income and expense items all of a sudden seem out of line with what you expected. And that's what analytical procedures are all about in the beginning. What did I expect numbers to be based upon what I know of the client? I've sat with the client, I understand their business, I understand where they've been this year. Once I've done that, I can design substantive procedures to cover me based upon the risk I've determined, based on looking at the numbers, okay? I looked at the bank accounts and I only got $1,000. Well, I don't think I'm really worried about that. So I've done an analytical procedure. I've looked at the numbers, they don't seem material. I'm not going to waste my time here. Because remember one thing about audits. While we talk about them, how can we make them better and better and better, there are time restrictions, there are dollar restrictions. We've got to get them done efficiently. We only have a certain amount of time to get them done. We can't audit forever. You can't look at every transaction. So you want to be as efficient as possible and accomplish as much as possible in the shortest amount of time possible. So doing analytical procedures can help you with your risk assessment. You do it again in your final review, and always part of your final review, when you do your final analytical procedures, is to explain the numbers. Sales were up this year. I was looking at a final analytical in our work papers. I'm going to say, okay, sales last year were $1 million, this year's $2 million. Why did they double? There should be an explanation in there. Not just I audited all the sales invoices for the year, and yeah, Mr. Cohen, there were $2 million in sales invoices. Why are sales double what they were last year? Explain from a business standpoint. Gross profit this year was 8%. This year it's 3%. Why? Should be an explanation in the papers. Not just I looked at cost of goods sold and everything seemed fine. Why did my margin drop by over 50%? Those are all important substantive, analytical things that you need to do as an auditor. It has to be in your work papers. It's all developed around, again, this is why you need to get trained as an auditor and as an accountant, because you develop without the training and the understanding of the client and what you do for a living, you don't know how to develop what's called an expectation of a balance. You need to be able to look at a number and say, why is it what it is? And this is something I talk in financial all the time. So you can do all the debits and credits in the world, and that's great. But the real key to accounting is not getting the debits and credits right. It's in understanding the numbers. What do you expect them to be? What do they mean? And a good accountant can sit and look at numbers and say, these are good numbers, bad numbers, high, low, they should be this, they should be that. Why aren't they what they're supposed to be? So then when you're doing your analytical procedures, you're developing your expectations, you're coming up with what you say is an acceptable difference. The inventory went up 2%. We say, well, okay, that doesn't worry me. That seems to make some sense. I'm not as worried about the inventory account. And you eventually investigate and evaluate significant differences. That's what you're doing. Again, significant differences could be a sign of a material misstatement. Inventory doubled. Okay, is the client trying to inflate their inventory in order to inflate their income? Are they trying to put the inventory as high as number as possible so that their income is as high as possible? Where do you get your expectation from besides your own intelligence? Prior period? Always start with that. Whenever you see an analytical procedure, you're going to see two columns, this year, last year. It's a very natural thing in accounting to always compare this year to last year in your company. So you're going to do this year against last year, that's your starting point. Anticipated results. Now, that doesn't mean you anticipate this year to be last year. The client said, I had a terrific year this year. Sales boomed. I'm up 50%. Okay, last year was $1 million. I'm expecting $1.5 million. Relationships between financial elements. Sales went up 50%. Cost of sales stayed the same. I don't think so. That doesn't make sense to me. Why is... Okay, you told me sales went from $1 million to $1.5 million. That makes sense, but cost of sales is the same number. That relationship's out of whack. Okay? Sales went up. How come receivables are down? I would have thought if sales went up, my receivables probably went up. Why are receivables down and sales are up? Industry information. You know a particular industry that you're dealing in having a problem this year. Company says, I'm having a great year. Well, geez, the information I read in the paper says industry's not doing so well. And then relevant information between financial information and non-financial information. Gee, salaries are up on the books, yet you told me salaries were up on the books, yet you told me you had a whole bunch of layoffs this year. That doesn't make sense. If you fired a lot of people, how come salary expenses up? Is that account correct? So you're developing you're looking at financial information against other information, other relevant data that you might be able to procure. You look at trend analysis. Things going up or down over time. Company seems to be growing. All of a sudden they had a bad year. Why? Doesn't seem to make sense. And ratios. You're going to do all the ratios that you learn in finance. Liquidity, leverage, profitability, gross profit, inventory turn. You're going to look at all those things analytically to see if it helps you make sense of what the numbers you see that you're going to audit and develop how much risk there is based on all these numbers. You put these numbers down, they all come out making sense. Your risk goes down. You can do less substantive tests. You can look at less stuff because everything seems to be the way you expect it to be. There's different types of doing ratio analysis, and I'm not going to go into this in detail, okay? This slide just talks about potential misstatements you could find by analytical procedures. I think I've sort of talked about these. It really is just something you can do. How do you audit estimates? one of the most difficult things to do. In financial accounting, we teach you about the debits and credits of the reserve for bad debts, reserve for uncollectible accounts. And we give you numbers. We say, okay, we're going to put 1% on the first column, 2% on the over 30 days, 3% on the over 60, and 10% on the over 90 or whatever. How do you audit that? I mean, is that auditable? Well, you've got to do something to test management's review and testing, okay? And you can only do it by using some type of process to develop it, how they develop the estimates. So a lot of it's discussion, a lot of it is common sense, a lot of it is you developing your own sense of it. I look at bad debts over a period of time and I see the level that they're at. Say, does this make sense that this reserve is in line with the level that bad debts have been historically? Does that make sense? I go through the receivables and I go through the old ones and I specifically pick out the big old ones and zero in on them independently. I sit down with the people in collection and I say, you know, you got 3 or 4 big old accounts receivable. Let's talk about them. What's your chance of collecting? What have you done to collect them? What is the status? Is this coming? When did they last pay? They're going to BS you, Papas. Yo, this is good. I've talked to the guy. But you're going to use your common sense. And at the end, you're going to say, okay, based upon that conversation, I think it's a 50-50 chance this receivable is going to take off. So you're going to possibly put a reserve on that one. Can you test it? No, it's not an area you can test. You can't pull an invoice. This is not something where you can verify by looking at a document. So you've got to use your common sense as an accountant, common sense as a person. Look at the economy. I mean, this is one of the first things. Is the economy went in the tank. Any client we went to, we said, listen, last year you had a 2% reserve for bad debts. This year you tell me it's a 1% reserve. No way. Exactly. I'm sorry. No, you're right. That doesn't make sense to me. Why did the reserve go down? You think your customers have a better chance of paying this year than they did last year? Makes no sense to me. You got to increase your reserves. And you know what? People reading your financial statements are going to see the same thing. You want to go out there, the financial statements look silly? Do you think we argue with clients about reserve for bad debts often? You're darn right you do. This is the areas you get in the arguments about. The soft things. The estimates, the reserves. The estimate for warranties. The warranty liability. You know, it's a guess. It's an estimate. So management's going to do their thing, and you're going to do yours. Subsequent events. This is a good way of testing reserve for bad debts as best you can. You come in March, they give you your December 31st receivable list. They determine a reserve for bad debts. You pull the March receivables now, or February balance. And you see a whole bunch of the December ones are still outstanding at the end of February. Well, maybe the reserve wasn't right, and you go, hey, listen, you told me that 1% was good. 2 months later, you haven't collected 50% of your receivables. So you do whatever you can do, again, using common sense, to try and look at these things that you can't physically audit. It's not like verifying there's a building and what it costs. Things like reserves, anything that's estimated, an estimated liability for some type of a contingency in a lawsuit. Well, sometimes that's not easy to come up with a number. You've got to do the best job you can to document and come up with your reasons why you think the number that is being reported on is okay. That's what being a good auditor is. Fair value accounting. You learn this in financial. There's certain things that are valued at fair value. Okay? Have they taught you the 3 levels of input anywhere? Has that been taught anywhere along the line? Does that sound familiar? Okay. You go in and you audit a client that's got investments. They invest in all kinds of things. They have investments in stocks that are traded over the counter, in the market. They have investments in some other things that don't trade very normal. They have publicly traded securities that very rarely trade, and then they have other ones that are absolutely, they invested in a private company. Okay, we as auditors have to put each one of these investments into a particular category and disclose the investments by level, so that the reader says, okay, there's investments, there's level 1s, level 2s, and level 3s. Level 1s are inputs of observable quoted prices in active markets for identical assets, meaning they own stock in Exxon. Okay? You went to the Wall Street Journal, or you went online and you checked the price of Exxon on that date. That's a level 1 audit procedure. You verified the price of Exxon. You know exactly what it is. You're dead on. It's an easy audit procedure. Okay? Number 2, and they're going to talk here about discounted cash flows on a non-publicly traded debt securities. You've got some type of a debt security that doesn't trade, okay? But there's some very comparable ones, equal risk, equal rating, possibly equal interest rates of publicly traded ones that you're going to use is what's called a level 2, okay? Similar assets, not identical, that you're using as audit evidence to verify your valuation, of the company's valuation. And those are what's called level 2 fair value assets. The lowest thing is what's called level 3s, where there's no observable inputs. I buy 70% of some private company. How do I determine what the valuation is? Is the company overvalued or undervalued? This is where you use your best judgment. You look at cash flows in the company. They paid expert last year and it's losing a lot of money. Well, you start questioning the valuation of it. Should it be written down? But it's what's called a level 3 fair value. And when you get to the footnotes, if you've got these type of investments, you need to put a disclosure of level 1 investments, level 2 investments, and level 3. But auditing them, level 1s are the simplest. You go to some reliable source, which is easy enough these days. You just turn on your computer and there it is. And you can verify those assets, at least the valuation. These become more difficult and level 3s become the most difficult. Why do we get so hung up in related party transactions? Most transactions that we do in the majority of transactions, we do it what's called arm's length. We're dealing in the market. We sell things to people where we negotiate a price at arm's length. They're going to pay as little as they can. We're going to charge as much as we can. But eventually we get to the right price. We sell things in a marketplace where the pricing is determined by the market. Okay? So we know they're arm's length. But when we start dealing with what we call related parties, that's not necessarily true. Okay? What do we require as accountants to do related to related parties? Because the important thing that a reader needs to know when they read a financial statement, and we are required to disclose is, hey, are we dealing with all unrelated people? So these numbers are the way they should be, they're driven by market forces? Or are we sort of self-dealing amongst ourselves, where we can control the price, we can control the cost, and we sort of set the numbers? And I hope you understand that. You understand what a related party is? Example, I've got a company that buys, or sells to their subsidiary, okay? That's all they do. Say the company is located wherever. They're located in Mexico, okay? And they sell to us here in the U.S. They set the price at whatever they want. We have to pay whatever they require us to pay. Now, there are some controls over that. It's called what's called transfer pricing. The government just I don't know if any of you, maybe you took federal tax? They talk about transfer pricing in there?
No.
Okay. Well, it's not stupid.
It's got text too.
People can avoid taxes. If you have companies that operate in multiple jurisdictions, countries around the world, you want to try and, if you can, manipulate your profitability into those countries that have the lowest tax rates. That makes sense, right? So if the U.S. has a higher tax rate than some other country, and you have companies in both, your goal is to try and push the profits into the country with the lower tax rates, okay? Seeing as sometimes you sell and buy things between yourself, you in a lot of cases can control that. You can increase or decrease the price. Like I said, we have a company very local to our office that's a subsidiary of a Swiss company. They buy everything that they sell from the parent company. So the parent company determines the price they sell to the subsidiary. The subsidiary is market driven because they sell to the outside world. So the sales price is determined by the market. But the cost they pay for the product is determined totally related parties. They can increase or decrease their price from Switzerland depending on tax rates. They determine they want more profit in the United States. They decrease the price of their product to the U.S. Thus, the product, U.S. pays less for it. The profits over here, they make less over there. They sell it for less, they make less, but it's a consolidation. And total, they make the same, they avoid taxes. The Internal Revenue Service is not stupid. They audit this stuff. They have rules for these things. They have rules for these things, and they audit companies under what's called transfer pricing. So you companies are very careful about this, okay? They try to stay within guidelines, because if the IRS catches this, they just correct it.
Aren't companies supposed to disclose in related parties?
Well, from an accounting standpoint, they have to disclose related party. So in this case, our client, U.S. financial statements are totally bottom line driven by the parent company. It determines what they're going to pay for the run. We're going to sell you these machines, and this is what we're charging for. They can't buy their machines anywhere else. If they determine this year they don't want profits in the U.S. and they can get away with it for whatever reason, they'll sell the machines here at a higher price, keep the profits in Switzerland, hypothetically. I'm not saying they do that, but they could. You constantly have transactions like that. Companies that have a client that is in the retail business, they have over 100 stores. The stores are all owned by the owner of the business, outside this company. So you got the corporation here operating 100 stores. The retail stores, the real estate is owned by the owner of the business. Well, he determines the amount of the lease payments. If he wants more lease payments, he increases the amount of the rent. He wants less, he wants the company to do better, he can decrease the amount of the rent. He does not have to use a market rent. He doesn't go around the neighborhood and say how much per square foot is rent in this area. He doesn't care. He's paying himself in effect. He owns both of them. That's a related party transaction, and if you understand that, you'll say, well, obviously we've got to disclose that in the financial statements. So the reader understands, hey, listen, the results here are not necessarily indicative of real results of a company like this if they were dealing in the real world. In this case, they might pay more or less rents if they were at arm's length and renting real estate from an outsider. So what do we got to do? One, we've got to determine, extremely important, you got to find the related party transactions. Clients don't always just advertise them to you. They don't say, here's a list of all the related party transactions. You've got to look for them, and sometimes you say, maybe that company sounds sort of familiar. I was looking at one of the rental payments. The name sort of sounds like your name. Oh yeah, I forgot to tell you, that's mine. I own that real estate. Yeah, I'm renting it to the company. So you got to go, challenges to find undisclosed related party transactions. You ask management, You review SEC documents. If you have related party transactions in a public company, you're required to tell them all. You've got to tell the public, okay, listen, we're dealing with related parties here. And you look for anything that with unusual terms and you see something with unusual terms, you say, wait a minute, what do you mean a 1% interest rate on this? The going rate in the world is 8 or 9%. Nobody gives me 1%. This is a related party transaction. You look for something that's out of whack. If it's out of whack in the deal, there's a decent chance. In the real world where we're dealing with one's life, when some things are too good to be true, they usually aren't. That's when you're going to trip over related party transactions. And GAAP requirement is to disclose it. Audit documentation. First thing everybody always gets beat up for. When PCAOB comes in, peer reviewers come in, we do our own internal reviews. It's always a question, did you document? There's always a thing, did you document what you did? Okay? So what you put together in work papers in an electronic file has to support what you did, okay? It has to support that you comply with auditing standards, and it's got to support your opinion. So what do you expect to find in documentations, okay? What's the purpose of it? One is sufficient to enable an experienced auditor to understand the work performed. In other words, when you do your documentation, it's going to get reviewed. The procedure in all accounting firms is as follows. The staff does the work. Staff, the seniors. Person above you reviews it. Person above that reviews it. And ultimately the partner reviews it. Not necessarily, nobody reviews it in the detail that the person below did. That's the responsibilities of the people above you, is to review your work. Thus, your documentation has to be so that anybody reading it understands it, and we reach the conclusions that you did. All audit work papers have to be signed, dated by the preparer and the reviewers. So if you pick up an audit work paper, and I say pick up, I date myself, okay? You can't pick up anything anymore, okay? The entire Windows computer, all of Cohen Resnick is accessible, right? Everything we ever did since day one. We used to carry around, everybody know what paper is? We carried around work paper files. The worst part of the job was being the lowest on the staff. Because you had to carry the work paper files, and on big jobs, we used to carry around, I swear, trunks. Because you would have, there were jobs with 30, 40, 50 files like this, okay? We don't have the partner carry files. So the lower staff, you'd be walking through the airport like this with a work paper file. Thank God, I guess, for electronics these days. But yeah, we carry work papers around. So you got to identify who did the work and who reviewed the work. And then everything reconciles. You tie things in. The general ledger balance agrees with the schedule. All sounds logical, but that's what you got to do. All significant audit findings have to be addressed on there. And what you did have to be on there, and the actions taken to address them. The bank confirmation didn't agree to the balance on the books, but here's what I did to satisfy myself it was okay. The account receivable confirmation came in and didn't agree, but there was a subsequent payment that came in that makes it agree. So you've got to, this all has to be on there. This is why accountants get beat up all the time on documentation. They don't always write things down. What is this stuff necessary for? We learned it in the last chapter. Lawsuits, okay? Let me explain this simply. Clients never ask you how good an audit you did, okay? You think they do? You think they come in and go, did you get everything? Did you check everything? You know what they want? You to be gone, okay? They want you to come in, sign the opinion, say you're okay, and leave. They don't care if your work papers are sufficient. They don't check and go, Michael, last year, we were hiring new accountants. Nobody signed off on the work papers. You didn't do the proper sign off, and you didn't document everything properly. And that's not a client's concern. So what are we doing this for? We do this for us, okay? We've been hired to do a job, but this audit documentation is for us. When you get into auditing, you're going to find there's different work papers, okay? We got different types of work papers. The first, and you always have, it's called administration work papers. These are all the checklists and required documents we need to start an audit. The planning documentation, the budget, things of that nature, client acceptance, write up on who the client is and what they do. So we have all this administrative stuff before we lay pencil to paper and get to the client. You have a whole bunch of what's called administrative work papers. You would then, and by the way, the work papers normally go in a very particular order. Okay? I don't think anybody does it differently. So you start at the top if you have a file. If you had an electronic file or a paper file, on the top would be all the administrative stuff that goes with the job. Then you start with the basic working trial balance. You're going to have all the numbers. You do what's called lead schedules. Remember, most general ledgers have hundreds and thousands of accounts. They don't have one cash account, one receivable account. They have many. So we're going to be, what we do with lead schedules is we put accounts together that feed into financial statements. So it'd be a lead schedule for cash, for example. Cash lead schedule, say cash. Account 101, general cash. 102, payroll. And 103 is whatever, 104. And there'll be a total. And this number eventually of all the cash accounts will tie into the cash account on the balance sheet. That's what a lead schedule is. So somebody reviewing the financials, the partner comes in, he picks up the financial, he sees how much cash we have, he goes to the lead schedule and sees all the different cash accounts that go into that. If you've got any adjusting journal entries that you've recommended that the client accepted, remember that's what happens. We find things during the course of our audit. They may be material or they may not be material. If they're material, of course, we're going to want the client to adjust them. If they're not material, we accumulate them because while individually they may be immaterial, collectively they may be material. You find an adjustment to income that increases income. You find another, and you say, well, that adjustment doesn't increase income by a material amount. You find another one and another one and another one and another one, and next thing you know, you have 20 increases to income. You go, okay, in total, they're material. So you're going to have all your adjusting entries and if there's any reclassifications, meaning things you're not going to tell the client. Typical reclassification entry, you find a humongous credit balance in an account receivable. One receivable, giant credit balance. You go, well, how can a receivable have credit balance? You go, oh my God, this customer overpaid last year. We haven't sent the money back yet. Okay, well, that's not really a receivable. What is it? It's a liability. It's payable. So you might make it a journal entry, debit, receivable, credit, payables. It's a reclassification. You make the client take it out of receivables? No. You make a reclassification entry for your report, but you wouldn't make the client make an entry on his books. Then you have the supporting schedules. So say theoretically, again, we're auditing cash here. Cash is a major item. So we had a lead schedule that looked like this. Now we're going to have a schedule for this account, this account, this account for material. So we're going to have a cash schedule for 101, 102, 103, and we're going to audit those schedules, assuming they're material. If we determine cash is not material, we don't need to audit it. We may not even have cash schedules. We would write that in the planning memo. Cash is not material. It's a small number. It's never a big number in this company. Thus, we're not going to do any auditing on it. So we have supporting schedules, any analysis of the ledger accounts, there was the backup to these supporting schedules, any analysis that goes into it, any reconciliations that we need to do, Oh, attendance sheet. Reconciliations. What does that mean? We got back a whole bunch of receivable confirmations that didn't agree with the general ledger. They're different. Okay? We need to reconcile them. We have to put that in work papers. Customer said 1,000, we said 2,000. Difference 1,000, check received yesterday, check was in the mail. That type of stuff. It's got to be in the work papers though, because the confirmation is going to be in the work papers. We've got to have the reconciliation of the differences there. Any computational work papers, if we're doing depreciation, should be there. And corroborating documents. If there's something you need that you think is material, we bought a gigantic building this year. The largest asset on the books. We went out and bought real estate. Well, it's not the worst thing in the world to put a closing statement in the paper, okay? The document, yeah, we paid $50 million for this building. Instead of putting a little tick mark saying, look at closing statement, well, it's a material item. Put the document there. Make a photocopy of it, put it in your work papers, document what, your verification of it. Two types of working files. Current files, permanent files. Let's start with the bottom one first. Every job has what's called permanent files. When do you think we do most of the permanent files? When do we do most of the permanent files? Come on, take a guess. When do you think we would build up a permanent file in a client? What?
First 600 count.
This gentleman has it. Day one. I just got an audit. They hired me. I need to build up a file on this client, which I call a permanent file. I need your stock records and copies. I need all your leases. I want your major contracts. Okay? You bought a building last year, give me that, okay? So we get what's called, these are items that we continue to use year after year. If I'm verifying lease payments, okay? Why don't I have the file on the leases, okay? But I don't have to go back and get it every year. I got it. So it's called a permanent file. But he's right. That's why we estimate, we use a number, and I don't know if it's accurate. Most years, first year audit, we had 15 to 20% onto the cost. I'm not saying we charge 15 to 20%. We estimate 15 to 20% additional time the first year you get a client. If it's a 1,000-hour audit, year one will be 1,150 to 1,200 hours. It'll take 150 to 200 hours to build up your permanent files and learn the account before you can lay pencil to paper and start really doing the audit. Current files are this year's working papers, which are all indexed, cross-referenced, so you can go from one spot to the other. But that's something you do every year. So you're going to have this file, which you're going to carry forward every year, and you're going to have a current file for that particular year. So this is just going to go forward with you. And that was always a file I remember carrying out, because it was the heaviest file, because it had copies of all the relevant documents that you needed. You also will put in here, as time goes on, some historical things. You might keep records of income every year and other things that you want to just see a trend of. I can't even talk to you about these. You can go look at them in the books. These are copies of work papers, okay? So in an hour and 45 minutes, we've covered chapter 5. That's the basics of an audit, okay? That's what you need to understand in terms of what we do, why we do it. Anybody have any questions?